Yesterday, CoreLogic brought out their Home Value Index report for July. And on their website, it does say the index does show growth easing in most regions as new listings rise. So Tim Lawless is the CoreLogic Research Director in Asia Pacific Research Division. He writes, CoreLogic's National Home Value Index rose by 0.7% in July, marking a fifth consecutive month of housing value recovery. Since finding a flaw in February, the national HVI is up 4.1% following a minus 9.1 decline from record highs in April 2022. Nationally, home values minus 5.3% below the April 2022 peak, with only Perth, Adelaide and regional South Australia recording a new cyclical high in dwelling values through July. While housing values are continuing to record a broad-based rise, the rate of growth has lost momentum over the past 2 months, slowing from 1.2% in May. CoreLogic Research Director Tim Lawless noted that the most substantial reduction in growth has occurred in Sydney. After leading the upswing, the monthly pace of growth in Sydney housing values have halved from a recent high of 1.8% in May to 0.9% in July. Sydney has also seen a significant rise in the number of fresh listings added to the market, 9.9% higher than the same time last year and 18% above the previous 5-year average. An increased flow of new listings provides more choice and may be working to reduce some of the urgency felt among the prospective buyers, he said. Brisbane and Adelaide saw the monthly pace of growth accelerate in July, leading the pace of gains across the capitals, with housing values up 1.4% across both cities. Although the trend in new listings has risen in these cities, Mr. Lawless said that the number remains well below levels from a year ago and the previous 5-year average. Canberra was the only capital city to record a decline in values in July, down minus 0.1%, while Hobart values were unchanged. The slowdown in value growth has mostly been driven by an easing in gains across the upper quartile of the market, while the growth in the upper quartile of the combined capitals index diminished from 1.8% in May to 0.7% in July. The lower quartile, 1%, and the broad middle of the market, 0.9%, remained resilient in July, following a smaller but more consistent rate of growth over previous months. Some resilience in growth across the middle and more affordable end of the market aligns with housing finance data, which has shown a stronger bounce back in the value of lending to first home buyers and investors across and over the recent months, Mr. Lawless said. These segments tend to be more active across the middle to lower end of the price range, where competition to purchase a home may be more intense. Premium housing markets tend to lead the cycle, so the slowdown in pace of growth could be a sign of a broader easing in the pace of growth over the coming months. Regional values continue to lag behind the capitals, with the combined regions index rising 0.2% in July compared to a 0.8% increase across the combined capitals index. Every rest of state region recorded a smaller change in dwelling values through July relative to the capital city, reflecting milder housing demand across regional Australia as demographic patterns normalise. The largest rise in regional housing values over the 3 months ending July, based on SA4 regions, has been the Gold Coast, 4%, the southeast region of Tasmania, 3.1%, and Newcastle, Lake Macquarie region, 3%. On the flip side, the weakest conditions over the rolling quarter were confined to areas of regional Victoria, with Bendigo minus 3.7%, recording the largest decline, followed by Shepparton minus 2.3% and Warrnambool Southwest region minus 2.3%. The flow of new listings added to the capital city housing market lifted by 3.9% over the 4 weeks ending July 30, bucking the usual seasonal trend where new listings would generally reduce through winter. Most of the capital cities have recorded a rise in the number of fresh listings through July, although Sydney was the only city where the flow of fresh stock to market was higher than a year ago, 9.9%. Mr. Lawless speculated that there may be a few reasons why vendors are becoming more active at a time that is normally seasonally subdued. The flow of new listings was held at below average levels since September last year, with total stock levels still low and selling conditions reasonably strong. It may be the case that more homeowners are picking current market conditions as a good time to sell, rather than waiting until spring when stock levels might be high, creating more competition among vendors. Another possibility is that we are seeing the first signs of motivated selling as the rapid rate hiking cycle catches up with household balance sheets, Mr. Lawless said. Although new listings have trended higher, overall capital city advertised stock levels remain low, tracking at minus 18.3% below the same time last year and minus 23.3% below the previous 5-year average. The fact that total stock levels are still trending lower implies demand is keeping up with increased flow of new listings coming to market, Mr. Lawless said. Total listings were holding below the previous 5-year average across capital cities, except Hobart. So if you're interested in receiving the complete July Home Value Index report with graphs and charts and in-depth commentary, please get in touch with us and we'll be able to help you get the download. And inside of that document, it has an analysis on listings, sales volumes, rents, rental yields, market outlook, top 10 capital city SA3s with highest 12-month value growth, dwellings, and top 10 regional SA3s with highest 12-month value growth in relation to dwellings. And if you would like to get your home on the market today, or if you're interested in finding out what actually is happening in our area, please get in touch with us and we'd love to help you.